Hello, I'm David Chaston with 90 at 9, brought to you by Interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, investor risk appetites are up sharply today in what looks like a completely irrational mood swing. On Wall Street, equities are very much higher on hopes Congress will pass a huge fiscal stimulus bill, bailing out many of them. The S&P 500 is up more than 6% in mid-afternoon trade, reversing yesterday's 3% fall and more. But for March, it is still down a net 19% for all of the yo-yo going on in between. The reason companies need that fiscal stimulus and the Fed's unlimited support is that the real economy is in a bad way. The US factory sector is now contracting and now at an 11-year low. But much worse, their service sector is contracting very steeply and now at an all-time low of a PMI of 39.1, where a score of 50 is a stable state. Sadly for them, is likely to dip further as the gloom spread as unemployment explodes. The next regional Fed survey in the Mid-Atlantic States District didn't reflect the PMI manufacturing gloom, but it did reflect the bad employment track with a sharp net shedding of jobs in the region's factory sector. Nationwide, car makers are shutting down and laying off workers. They mirror the aviation industry, and the American real estate industry is going to a sharp reverse. Worse, their $3 trillion commercial mortgage market has borrowers with tenants who just can't pay the rent. And none of these impacts only affect the US. The list of impacts goes on, and it's unclear what investors see in the huge fiscal packages that will reverse the bite of layoffs and closures. Still, across the Atlantic, European markets rallied very strongly, with most up 10% on the expectation the Americans would join the Germans and others in massive stimulus. Earlier Asian markets set the tone, although not quite the same bullish levels. In China, Hubei province is being released from lockdown, and the number of new cases evaporates as the recovery rate surges. It's now almost 90%, with only 4,300 active cases left in the province. Nationwide, the recovery rate is now over 90%, but that is leaving behind economic devastation. Chinese companies had their worst quarter on record, with every individual sector reporting worse results in the first 3 months of the year, according to the China Beige Book. Major infrastructure projects are now getting a renewed boost, and these are so big that it's keeping core commodity prices from falling. In Australia, they're facing a virus storm because of an inadequate response mirroring the US. A wide range of economic analysts predict their economy will shrink by 3% or more this year, and more than 1 million people will soon be out of work. Retail and the related commercial property sectors will be particularly hard hit. Many businesses just won't survive. The US Treasury 10-year yield is rising again, and also on a wild yo-yo ride. It is now at 0.83% and up 8 basis points since yesterday. And gold has risen very sharply today, up another $69 to $1,614 an ounce. And US oil prices are up $1 today to $23.50 a barrel, and the Brent benchmark is at $27.50 a barrel. And the Kiwi dollar is starting today a lot firmer than this time yesterday, up 1 cent to 57.9 US cents. The greenback is being sold down. On the cross rates, however, we're lower at 97.7 Australian cents, but most of that fall happened early yesterday. And against the euro, we're also firmer at 53.7 euro cents. That means that our trade weight index is now at 65.5, and its highest in more than a week. I'm David Chaston. That was 90 at 9, brought to you by Interest.co.nz.